Hi, everybody. This is Kevin Gormley. I'm a CPA that does financial planning. And today we're going to talk about, for those of you that are high income, creating wealth from that high income. So we're calling it high income wealth. And the most important thing I can tell you is to act today. I used to think it was a lot of other reasons why people that made a really high income were not getting as wealthy as they possibly could and were being stalled in the process. I actually think procrastination is one of the big issues, and that's really what I'm going to focus in on this video, along with some thoughts around taxation. I won't get into the mud, I promise, but just doing some things that are, I think, really easy to act today and to move forward and take your high income, which you worked so hard to build, and to turn it into wealth. So, what are the greatest controllable costs that you have when you're high income? Is it the cost, the fees to invest? If you pay somebody to invest, can you control those costs? Yeah, probably. Fees for advice, maybe from a CPA or other tax professional. Taxes themselves. And this is absolutely huge. Nobody wants to talk about this, so I'll just tell you that by controlling what you invest in, at least with the investment income, you can cut the amount of taxes you pay on your income in half, and maybe even more. So, and then bad decision making. This, unfortunately, for all of us, no matter how many degrees you have, human beings are not wired to invest, and having some type of system and systematic approach, a method to what you do is extremely important, because bad decision making absolutely is something that can be controlled, but it's not easy to do. And the answer for this question, what is the greatest controllable cost, is it depends on each client. But one of the things that I've seen recently is procrastination really gets in the way. And it's not that you're trying to procrastinate, it's just that you have so many other things with family, with going out and making a living, so many other things to do. So the high income investor, we define that at Leading Edge Financial Planning as making more than $200,000 per year in your career. May or may not have wealth, and I'll talk about the four quadrants of how much income you make versus wealth. You may or may not be a single person, or it could be a couple. And Warren Buffett, really interesting enough, Warren Buffett said in 2002 in the Forbes article that he paid 17.4% tax on his money. So for every dollar he made, he paid 17 cents out, but his secretary paid double. And so having a tax smart strategy as part of your investment plan, that's our focus. So investments, financial planning, and taxation, the interrelationship of these items is really critical. And that's what we focus in on. Now, there is a perception for those that do not make high income. There's a perception that you are lucky, you're rich if you make more than $200,000 a year. Well, you're just rich. You make high income, therefore you're rich. That's not always true. And you're lucky to be making so much money. People don't know about all the hours that you've put in the past to acquire the job that you have or the career that you have, nor do they know how many hours you put in per week. And you should have less money concerns because you're wealthy. The truth is, the reality is, there's only so many years you can trade your skills for the high income. If you run out of years, you run out of high income. And there's pressure to build enough wealth so when you do leave, you can have the same lifestyle. It's called lifestyle creep or lifestyle inflation. The greater you live your life, the harder it is to go backwards. Again, a human behavioral emotion that's just part of who we are. There's always multiple financial priorities. You have kids, you have the house, you have to fix this, you have to do this. Fear of losing the ability to learn. So maybe it's really a low stress level for some of you, but what happens if our jobs get displaced because of robotics or because of someone else in another country doing our job for a lot less? And then time is a very valuable resource. And this is many times the reason why we procrastinate, is because we just don't have that much time and we don't want to focus all our great time on money. So many do dream about leaving their current profession from being overworked. And so we want to create another way. So there is income, and then there is wealth. If you look at this first quadrant, you're high income, but you don't have a lot of money. And this is people that just graduate and get great jobs, or people that just start a company maybe that starts to take off. you don't have a lot of wealth yet. There's quadrant 2, which is the great quadrant to be in when you're high income and high wealth. You make a high income, but you also have a lot of money. The money is the freedom. The income is not the freedom. And then low income, low wealth, this is where none of us want to be. And then low income, high wealth, this is a pretty good place to be. And the more money you have on the wealth side, the more you can do, the bigger pile of money you have, the more you can do from tax planning. Okay, because your income from work, it's really hard to stop that from getting taxed. And that's what this is showing here. Which type of income can we control the type and potentially the timing of taxation? Well, the income from work, you can defer. 401k, SEP, simple, tax deferred accounts. There's many different types of accounts. And yes, we believe in when you're high income, deferring as much as you can. But after the money is taxed, this is really where the area where you can spend the money or you can grow the money. And the money that's already been taxed can grow your net worth because you run out of places to put tax deferred money. 401k, you can only put a certain amount of money in there. Pension plans, you can only put a certain amount in there. So money that comes into this taxable bucket, this is the place where the high income team at Leading Edge Financial Planning can help you with tax smart strategies. Taxes crash. Okay, if you're at the 49.4% tax bracket, okay, if you put your money in, we're talking about your investment money, if you put it at risk and you make $1, you may share up to 50% with the local and the federal government. Okay, if you lose money, you only get capital losses to offset capital gains of $3,000 more per year. So you take all the risk, but you have to share the profits with the government, and this is why it's so important. Now, this is the system that we're in. This was from Michael Kitces, and I'm not going to leave this up here for long because you'll click off. But this is just showing how awesomely complex our tax system is, and as you go higher and higher income levels, you pick up more and more taxes, and that's the reason why it gets very ugly in the high tax brackets. So most high income investors are not aware that when it comes to your income, your investments always go on top. So if you're in the 39.6% tax bracket and you earn $1 at the bank, you're only keeping 60 cents, and that's before the other taxes that I won't go into. So I'm going to skip through the next 3, but it's just saying it's not about even your tax rates, it's how much you keep. So there is a saying in the tax world that the tax tail should not wag the dog. Do not allow the tax tail to wag the dog, basically, is the saying. So it's all about the after-tax returns. So, we don't want to just save tax money and say we're getting one over on Uncle Sam and then make no money. We'd rather get a 10% return and pay 45% tax and only keep 6.5% than get a 2% return and pay 10% tax. You're going to still make a lot more after-tax money, and it's all about the risk return. I realize that. But there is an awesome difference between paying 45% tax or 20% tax on an investment, and we can control this. So there's a few solutions here. The first solution is asset class awareness, and that's to understand the investments that you choose. If you choose a stock, for example, in the form of funds, or if you choose a bond in the form of funds, or real estate as a rental property, or master limited partnerships, or muni bonds, the investments have different tax preferences, very important. And then we believe, Charlie and I strongly believe, as well as Will, that you absolutely should set up as many account types as you can and have some tax diversification and have it on automatic pilot. I guess that's a pun intended for Will and Charlie. Have it on automatic pilot, because the more you have money going into certain places, when you're high income, you're busy, the less you have to think about it. So if I can arrive at retirement and if I could have all the different account types, I would love to have them all, because then I can pick and choose where I want to pull money from each year. And I can keep and fly below the radar when it comes to taxes. So then asset location, which is putting the tax ugly assets into places where you don't have to pay current taxes. And then putting the tax friendly assets into places like taxable accounts, for example. We're okay to pay taxes when it's in a place where the tax is not very much. That's the key. So the other part of on the road to solution here is if you're charitably inclined, do some things to set up your financial affairs to be able to give more by giving investments, for example, that have appreciated, by using donor advised funds in years when you're going to make an awesome amount of income and then giving it away in other years. And then having a written plan, now it's no longer written. We can make these plans together on software, but really it's the visual aspect of it. So we don't want to do things that are exciting. I know a lot of clients, they hear about exciting opportunities because they have money. Everybody knows they have a high income. Everybody brings them exciting opportunities. We don't want exciting opportunities. We want to grow wealth in a prudent way. So having a written plan is good. And then tax strategies with your tax CPA. So here's all the different buckets. The thing I want you to take away from here is as you go to the left, this is money in the bank. As you go to the left, this is higher tax. As you go to the right, it's lower or no tax. Okay, so dividend income from stocks, equities, it's preferentially treated versus bonds or bank accounts. Capital gains preferentially treated. Tax exempt muni bonds preferentially treated. If money's in a pension or an IRA, it's tax deferred. And then real estate is a fabulous investment. Although I don't have a brokerage license, none of us do. We will help people look at rental real estate or other types of real estate where you can use your best friend depreciation as a tax shield. So you may not know what a depreciation shield is, but we can show you how you can take your income and you can use depreciation, which is a phantom expense in real estate, and shield your income from it. Now, you eventually have to recapture years in the future, but maybe you're not going to be high income then. And then the Roth IRA and the insurance, and we also use very, very low cost variable annuities. So what types of investments that are high income, that should a high income investor consider? Well, low turnover funds, ETFs, passively managed DFA funds, and we only use tax efficient funds in taxable accounts. The right types of ETFs, okay? Not all our ETFs are created equal. Whatever the investment is inside the ETF is the type of tax the ETF will cause you to generate. Oil and gas master limited partnerships, their return has been 8% in the last decade. Now, they had a very poor year in 15, so many people have been turned off to these. But high income investors, this may be the time to look at them. Non-publicly traded REITs, okay? There's been a lot of great things that have happened in this space. People aren't selling these for the great commissions anymore. So they're getting more and more due diligence put on them. And again, if you don't want to own rental real estate, non-publicly traded REITs, you can still have the depreciation shield, muni bonds. What types of investments should you avoid? You should always avoid actively managed mutual funds. If your mutual fund is run by a person, if your mutual fund person is on TV, if your mutual fund has some great logos and stuff, probably not only will they not do as well as their passively managed index fund, but they're also going to have higher turnover. If you have this in a after-tax account, they will crush you with taxes. So tax ugly assets such as REITs, in this case, real estate investment trusts, bonds, high yield bonds. You should never use an investment just for a shelter, tax shelter. We've talked about the fact that you don't want to let the tail wag the dog. Hedge funds, almost always a bad idea. I would say always, but there might be one good one. And then commodities. Should never put those in a taxable account because, again, you will get hammered. So I'm just going to end the video by saying that we understand the asset location benefits. We understand the benefit of tax deferral with new low-cost variable annuities. If you wanted to use a low-cost variable annuity, you can put money in there and you can grow the money, tax deferred, and then when you take it out, yes, you will have to pay tax on it, but that is another tool. But the last thing I'd like to say is, and maybe the most important thing, is that all of these strategies are are really terrific. But the biggest thing that we add as advisors, I believe, to high income investors, the biggest thing we add is the ability to take action, implementation, get the investments going, rebalancing, talking about what we don't want to do and what we do want to do. It's called behavioral coaching. But again, if you're really busy, you might not have time to look at the markets. You might hear something from someone else, and we can tell you, hey, that's not part of your plan. Sometimes we can say, okay, if you want to do it, that's fine, but it's your decision, it's your money. But we can help you with those issues and maybe reframe it so you're not hearing just the positive side of it. Asset location, where to put your money. It's so easy to put the right assets in the right accounts and not have to pay the 49.4% taxation. It's not hard to do, but it has to be done. And then when you get to retirement, a spending strategy, and then a total return versus income investing strategy. But these are the things that we bring. Procrastination is the big evil when you're high income. You want to get into that area where you're high income and high wealth. Thanks so much for watching. I'm Kevin, a CPA that does financial planning for Leading Edge Financial Planning. Thank you.